My name is John Gens. I'm a tax partner in the New York City office, and I'm going to cover the impact of ASC 740 and the income tax accounting of all these things we've been hearing about. So there's many items in the CARE Act that are going to have income tax implications. There's going to be changes to deferred taxes, which is going to include changes to the valuation allowances, balance sheet classification, potential impairments of assets and goodwill, and the potential inability to forecast due to these economic disruptions. The CARES Act impact is included in the period of enactment, and it was signed into law on March 27, 2020. So for everyone that had an extension to tax season, unfortunately, provision season for Q1 did not get extended. And a lot of these decisions have to be made currently. Excuse me, a lot of these decisions have to be made now in order to report these correctly in the first quarter provisions. Consideration, as Dave Seidman mentioned, should also be given to the state impact of these changes, and there's many items where additional work papers will need to be put together for the provisions in order to calculate the impact of the CARES Act. Net operating losses. So as Allison just went over, all the carryback opportunities, the removal of an 80% limitation, we need to look at how this is going to impact the accounting for income taxes. So federal and state NOL carrybacks, they may be one of the four sources of taxable income to support the realization of other deferred tax assets. And since the federal tax rate has changed from 35 to 21%, it also may require the federal net operating loss deferred tax assets to be remeasured, or part of them to be remeasured at the 35% or a higher rate that they can recover this in a back year. Valuation allowances may no longer be necessary against net operating loss deferred tax assets if this new carryback opportunity is available. These changes, since the law was enacted in Q1, need to be reflected discreetly in the period of enactment. And keep in mind, credits originally claimed on prior year returns, such as foreign tax credits and R&D credits, may now result in carry forwards after you carry losses back. And if you had valuation allowances against other tax attribute carry forwards like the NOLs, you may now need to have valuation allowances against some of these credits. So it's a lot of circular calculations in coming up with the proper reporting for Q1. And as Michael went over, the 163J interest expense limitation, the current year tax effects resulting from this increased ATI limitation, and the election to utilize 2019 ATI for the 2020 limitation should be reflected in the current year annualized effective tax rate. Additionally, the federal and state income tax effect of changes in the prior year ATI limitations should be accounted for discreetly in the interim period. That includes the date of enactment, including changes in any valuation allowances. Now, it is possible that the change in this interest expense limitation for 2019 may transition that year from a positive taxable income year to a net operating loss, resulting in a carryback. And again, that carryback may need to be revalued at a higher tax rate and create an additional benefit and some much needed cash for many of the companies. Companies should also consider the international tax impact of this increased ATI limitation, such as the impact on FDII, GILTI, and BEAT. Alternative minimum tax refunds. AMT credit carry forwards may be presented as either a current or non-current receivable or a deferred tax asset in a prior period balance sheet. Now, the presentation of these refundable AMT credits in the balance sheet should be updated to reflect the timing of when these credits are expected to be utilized from a non-current receivable or deferred tax asset now to a current receivable. Qualified improvement property, as Paul covered earlier. The impact of qualified improvement property technical correction on any position taken in a prior period should be recorded discreetly in the interim period that includes the date of enactment. Again, these potentially significant depreciation deductions could trigger a net operating loss in a back year that can be carried back. And companies may plan to file federal and state amended returns for prior periods to claim a benefit, which could result in a refund receivable and a change in the deferred taxes related to all your fixed assets. Companies should consider the potential rate impact of qualified improvement property technical correction if it creates an increased NOL to a back year. And the technical correction constitutes new information that may be allowed for recognition of uncertain tax positions and related interest and penalties. So if you took the position in a back year that this was qualified improvement property when it was not enacted into law, you may have had an uncertain tax position on your financial statements, which is now reversed as a result of this technical correction. The indefinite reinvestment assertion. So due to these economic disruptions, companies may need to evaluate their indefinite reinvestment assertion for both historic and current earnings. Are they going to be distributing cash from foreign subsidiaries back up to the U.S. entities? So companies that do not assert indefinite reinvestment may be subject to other taxes on those earnings, such as withholding taxes. And the foreign currency translation adjustments related to foreign withholding tax liabilities from year to year are recorded through the income statement and rather than through equity. And companies that no longer assert indefinite reinvestment would also need to consider potential deferred taxes related to unrealized foreign currency gains or losses on previously taxed but unremitted foreign earnings included in the toll charge. State taxes and changes in law would also need to be considered when evaluating the indefinite reinvestment assertion. Next slide, please. Grants and employee retention credits. There currently is no U.S. GAAP that specifically addresses the accounting for business entities for governmental assistance. Companies will need to analyze the nature of the assistance and look to available guidance or similar transactions to determine a proper accounting treatment. For instance, is there guidance in IFRS that may assist with how to record these items in the financial statements? For instance, the Payroll Protection Program loans are classified as a loan until they're potentially or partially converted to a non-taxable grant. If all or part of the loan is converted to a non-taxable grant, this will be a permanent book-to-tax adjustment and a discrete item in the reporting period of conversion, also impacting the annualized effective tax rate. And of course, keep in mind, any state and local tax impacts to these conversions as the states are trickling in information and whether or not those are going to be considered non-taxable grants for state purposes is yet to be seen.